There's a strange thing that happens to people once they cross a certain number in their bank account. Not a million, not even close, just $100,000. Money experts have quietly known about this for years, but almost nobody talks about it because it doesn't sound exciting enough. It's not a Lambo, it's not a mansion, it's just a number on a screen. But ask anyone who has actually reached it, and they'll tell you something strange happened after that point. Money started moving differently, growing differently, almost like the rules changed. And here's the part that surprises most people. It's not because they suddenly got smarter with money. It's not because they found some secret investment. It's because of something most people never notice, a quiet shift that happens once you build a certain amount of momentum. Today, we're going to break down exactly why your first $100,000 is the hardest, why everything after that starts to feel easier, and why understanding this one idea could completely change how you think about building wealth.
Let's start with the problem almost everyone runs into. Most people believe that building wealth is a straight line. Save a little, invest a little, and slowly watch the number grow at a steady pace. It feels logical. If saving $500 a month gets you to $10,000 in a certain number of years, then doubling that time should just double the result. Simple math, right? But that's not how money actually behaves. And this mismatch between how people expect wealth to grow and how it actually grows is the reason so many people give up right before things were about to get easier. Think about someone trying to save their first $10,000. It feels like climbing a mountain. Every paycheck feels like a battle. You cut back on eating out, you skip a few trips, you say no to upgrading your phone, and slowly, painfully, the number creeps up. 10,000 becomes 20, 20 becomes 40. It feels like the effort never stops, like you're always pushing a boulder uphill.
Then it hits 50,000. Same pace, same effort, similar frustration. Then, seemingly out of nowhere, something shifts. Getting from 50,000 to 100,000 doesn't feel as brutal as getting the first 50. And going from 100,000 to 200,000, people often say it happens faster than they expected, sometimes shockingly faster. This is where most people get confused, because it feels like magic. But it's not magic. It's math. Simple, quiet, patient math that most people never stop to actually look at. Let's break it down. Imagine you save and invest money, and you're earning a modest return each year, let's say around 8%, which is a reasonable long-term average for many types of investments. When you only have $10,000 invested, an 8% return gives you $800. That's barely noticeable. It's not exciting. It doesn't feel like progress. Most of your growth at this stage is coming from you, your effort, your paycheck, your sacrifice. But now imagine you have $100,000 invested. That same 8% return gives you $8,000 in a single year, without lifting a finger, without skipping a single coffee, without picking up a side hustle, just from the money existing and growing on its own. Suddenly, the money itself is doing serious work. It's not replacing your income yet, but it's contributing in a way that starts to feel real. And here's the key insight most people miss. The first $100,000 is mostly built by you. Everything after that starts being built by your money. This is the moment where saving transforms into something else entirely. It transforms into compounding. Compounding is one of those words that gets thrown around so much that people stop actually picturing what it means. So let's simplify it with something everyone understands: a snowball rolling down a hill. At the top of the hill, the snowball is small. You have to push it yourself. It barely picks up any extra snow. Every bit of size it gains comes from your own physical effort. That's what building your first $10,000, $20,000, $50,000 feels like. You're the one pushing. But once the snowball gets to a certain size, something changes. It starts picking up snow on its own. It doesn't need your push anymore, not entirely. The size of the snowball itself starts generating more size. The bigger it gets, the faster it grows, and the less it depends on you pushing it. Your first $100,000 is basically the size where the snowball becomes big enough to start rolling on its own. It's still nowhere near unstoppable, but it's no longer purely dependent on your effort. It's earning its own weight for the first time. This explains why people who reach that number often describe a psychological shift too, not just a financial one. Here's where the money psychology part becomes really interesting. Early on, when you're saving your first meaningful chunk, but once your money starts visible growing on its own, something shifts in how your brain sees saving. It stops feeling like pure sacrifice and starts feeling like reinforcement. You start seeing evidence that the system works, and that evidence becomes motivating in a way that willpower alone never could be. This is actually one of the most overlooked psychological principles in personal finance. People don't stay motivated because of discipline, they stay motivated because of visible progress. And visible progress becomes dramatically easier to see once your money starts generating noticeable returns on its own. Before hitting that number, saving feels like walking through fog with no clear destination. After hitting it, saving starts to feel like walking a path you can actually see extending in front of you. There's another layer to this too, something psychologists call the momentum effect. Human motivation isn't linear. It's driven by momentum, by seeing tangible signs that something is working. Early in any long-term goal, whether it's fitness, a skill, or finances, results feel slow and invisible. This is usually where most people quit, not because the goal is impossible, but because they can't see proof that their effort is paying off. Money is no different. The first phase of wealth building feels invisible because your effort dominates the results. But the moment your money starts earning noticeable returns, you gain proof. And proof fuels motivation far more powerfully than discipline ever could. This is why financially successful people often say the first $100,000 was the hardest part of their journey. Not because the math is different after that point, but because belief becomes stronger. Confidence replaces doubt, and confidence changes behavior. People who feel their financial system working tend to make smarter decisions, avoid unnecessary spending, and stay consistent, not because they're forcing themselves to, but because they finally trust the process. Now, here's the deeper insight, the one most people never realize until much later in life. Wealth isn't primarily built through income. It's built through time combined with consistency. Many people assume that the key to getting rich is simply earning more money. But history is full of examples of high-income earners who stay broke and modest income earners who quietly build enormous wealth over decades, simply because they start early and stay consistent long enough for their money to start working on its own. The real secret isn't intensity, it's patience paired with structure. Getting to that first meaningful milestone isn't about being brilliant with investments. It's about surviving the boring, invisible, unglamorous stage long enough for compounding to finally show up and start pulling its own weight. This is also why comparing your financial journey to someone further ahead can be dangerously misleading. If you compare your early, invisible progress to someone who has already built enough money to generate real momentum, it feels like you're failing. In reality, you're simply in a different phase of the same process they went through. So, what should you actually take from all of this? First, understand that the beginning is supposed to feel hard. That's not a sign you're doing something wrong. That's simply the phase where your effort matters more than your money. Expecting this stage to feel exciting or fast is the biggest reason people give up too early. Second, focus on consistency over perfection. You don't need the ideal investment strategy or the perfect financial plan. You need a repeatable system that keeps feeding your snowball, even in small amounts, especially early on. Third, understand that your money doesn't need to be huge to start compounding. Compounding starts on day one. It's just invisible in the early stages because the numbers are small. Waiting until you feel ready or waiting until you have a large amount to start investing is one of the most common mistakes people make. The snowball needs to start rolling as early as possible, even if it begins as a tiny, unimpressive little ball of snow. And finally, understand this. The version of you who reaches $100,000 is not smarter or luckier than the version of you struggling right now to save the first few thousand. They simply pushed the... Everything doesn't change because of some magic financial trick. It changes because momentum builds, confidence builds, and your money slowly begins to become an active participant in your life, instead of a passive number you're just trying to protect. Here's the quiet truth hiding behind all of this. The hardest financial mile isn't the one that gets you rich. It's the one that gets your money moving. Once it starts moving, it rarely wants to stop. So if you're in that early, invisible, frustrating stage right now, understand this is exactly where everyone starts. The boring part is not a punishment. It's the price of admission. And the moment your snowball finally starts rolling on its own, you'll understand exactly why everything changes after your first $100,000.